Chapter 2. Effervescent economies. Bubble, something insubstantial, groundless, or ephemeral, especially. A. A fantastic or impracticable idea or belief, an illusion. B. A speculative scheme that comes to nothing. Dictionary.com. Chapter 1 demonstrated how U.S. balance of payments deficits undermined the Bretton Woods international monetary system and caused a dramatic rise in international reserve assets comprised primarily of U.S. dollars. For individual countries, the rapid accumulation of reserves has proved to be a curse rather than a blessing, however. Those countries that have experienced a sudden, sharp growth in reserves became caught up in a domestic investment boom accompanied by rampant asset price inflation that eventually ended in financial calamity. The bubble economy that developed in Japan during the second half of the 1980s perfectly illustrates this point, as does the Asian miracle bubble that followed in the 1990s. The Great Japanese Bubble. By the end of the 1980s, land prices in Japan had risen to such an extent that the imperial gardens in Tokyo were said to be worth more than the state of California. Property prices were not the only evidence of Japan's bubble economy. Share prices commonly traded on price-earnings multiples of over 100 times. The Nikkei index peaked above 38,000 in 1989. Recently, it fell below 9,000. Clearly, asset prices were extraordinarily inflated. Surging credit expansion was responsible for the runaway asset price inflation and the unprecedented trade surpluses Japan had accumulated in the years following the breakdown of Bretton Woods had made that expansion of credit possible. As the surpluses were deposited into the banking system, money supply expanded remarkably, economic growth accelerated, and asset prices skyrocketed. The extraordinary surge in the Japanese stock market is shown in Figure 2.1. Figure 2.1 Japan's share price index, 1968 to 97, 1990 is equal to 100. Japan had become a major exporting power by the late 1960s. By then, it had fully recovered from its defeat in World War II and had once again become a formidable industrial power. The country's rising international reserves bore witness to the success of Japan's strategy of export-led growth. During the 1970s, the two oil shocks held Japan's trade surplus more or less in check, but from 1981 onward the country began to record an uninterrupted string of trade surpluses. See Figure 2.2. As those surpluses were deposited into Japan's banking system, they acted as high-powered money and set off an explosion of credit creation. Figure 2.2 Japan's trade surplus, 1968 to 99. Japan's trade surpluses in the 1970s appear small compared with those of the 1980s. However, relative to the size of the Japanese economy and monetary base at the end of the 1960s, they were nevertheless very significant. Furthermore, Japan also attracted net capital inflows during this period. These, too, not only boosted international reserves, but also entered the banking system as deposits and contributed to the growth of money supply and credit creation. Between 1968 and 1978, Japan's international reserves, total reserves minus gold, soared 1,146%, see Figure 2.3. Japanese money supply, money plus quasi-money, increased by 356%. Figure 2.3 Japan, total reserves minus gold, 1968 to 78. Therefore, it is important to keep in mind that when the period of extraordinarily large trade and current account imbalances began in the early 1980s, they had been preceded by a 10-year period when Japan's money supply had already expanded at a galloping rate. See Figure 2.4. Figure 2.4 Japan, money supply, 1968 to 78. In 1977, Japan began publishing a much more detailed breakdown of its balance of payments. From that point on, it is much easier to visualize exactly how foreign capital entered and left the country. That information is summarized in Figure 2.5. Figure 2.5 Japan, breakdown of balance of payments, 1977 to 99. As Japan's current account surplus began to expand at an extraordinary rate in the early 1980s, the country began to export capital in amounts that were almost as large as its current account surpluses. So long as capital exports, shown as the financial account deficit, were as large as the current account surplus, there was little impact on the country's overall balance of payments, meaning that the international reserves held by Japan remained unchanged. However, in years when capital exports were insufficient to offset the current account surplus, such as 1986 to 88, then the overall balance went into surplus, causing international reserves to rise. As can be seen in Figure 2.6, Japan's inability to export sufficient capital to offset its current account surplus resulted in its international reserves rising by 260% between the end of 1985 and the end of 1988. With more money entering the country than leaving it, it is not surprising that money supply growth also accelerated during this period, growing at the fastest rate since the 1970s, see Figure 2.7. In 1989, quasi-money grew by 15%, a rate of growth last experienced in Japan in 1975. Nor is it surprising that, after so many years of trade surpluses, rising international reserves, and swelling money supply, a new surge in all these factors in the mid-1980s would cause such drastic overheating of the Japanese economy in the late 1980s. Figure 2.6 Japan, total reserves minus gold, 1978 to 88. Figure 2.7 Japan, money supply growth, 1982 to 91. One of the themes of this book is that when national economies are flooded with foreign capital inflow, regardless of whether the capital enters the country as a result of trade surpluses or capital account surpluses, it causes economic overheating and asset price inflation. How differently the Japanese economy would have evolved had it not accumulated such large trade surpluses year after year. The country's cumulative trade surplus between 1968 and 1989 was 75 trillion yen. Over the same period, its international reserves expanded from $3 billion to $84 billion. There can be no question that those trade surpluses directly benefited Japanese exporters and the people they employed. Clearly, there would also have been a multiplier effect, as those firms and their employees spent money in the domestic economy. Without the purchasing power derived from the trade surplus, Japan's economy would have grown at a much slower pace. This is very well understood. What is much less appreciated is the expansionary impact that those surpluses had on domestic credit as they were deposited into the Japanese banking system. Each year that foreign capital entered Japan's banks, it acted as high-powered money and permitted credit creation. The rapid credit growth that Japan experienced during the 1970s and 1980s, see Figure 2.8, would not have been possible without those foreign capital inflows. There simply would not have been sufficient deposits to permit so many loans. Figure 2.8 Japan, domestic credit growth, 1971 to 89. The rapid rise in deposit growth, money supply, and credit was only possible because of the surge in foreign capital entering Japan. Moreover, once deposited into the banking system, the foreign capital could be lent not only once, but, because of the process of credit creation through the banking system, the original amount could be lent and relent multiple times. So, while there is no question that the Japanese economy was boosted by the direct benefit that exporters and their employees reaped from the trade surplus, that was not what caused Japan's economy to overheat. Instead, it was the capital inflows into Japan's banks and the extraordinary credit creation that those inflows permitted that caused the Great Japanese Bubble economy. The role of credit in creating the bubble is illustrated in Figure 2.9, which shows that the ratio of domestic credit to GDP in Japan rose from 135% in 1970 to 265% in 1989. Figure 2.9 Japan, domestic credit as a percentage of GDP, 1970 to 89. All credit bubbles ultimately end in deflation, because the purchasing power of the public does not increase quickly enough to absorb the surge in production that results from extended periods of easy credit. In other words, the ability of the public to buy does not increase in line with the capacity of industry to produce. When product prices begin to fall, debtors find they are no longer able to pay interest on their debt. Bankruptcies follow, credit contracts, and the economy enters recession. The Japanese bubble ended the same way. The surge in domestic credit brought about a sharp rise in gross fixed capital formation, share prices, and property values. Japanese industrial production rose 25% between 1986 and 1989, see Table 2.1. Table 2.1 Japan, as reserves expanded, the economy boomed, 1981 to 92. The phenomenon of asset price bubbles also plays an important role in boom and bust cycles. As credit expands, asset prices rapidly inflate, creating a positive wealth effect that spurs consumption and causes the rate of economic expansion to accelerate. Eventually, however, prices rise so much faster than overall income that it becomes impossible to pay the interest on the credit that financed the acquisition of those assets. Then, bankruptcies surge, financial sector distress begins, credit starts to contract, and asset prices plunge, creating a negative wealth effect that deters consumption and undermines the rest of the economy. The bubble in Japan popped in 1990 because overinvestment had created overcapacity throughout the domestic economy. Excess capacity exerted downward pressure on prices and profits. Slowing earnings were incompatible with frighteningly inflated share prices. When the Nikkei index began to plunge in 1990, the game was up and the bubble began to implode. Industrial production rose 1.8% in 1991 and then declined 10.4% over the next 2 years. Wholesale prices, which had been exceptionally weak in the mid-1980s due to the collapse in oil prices, rose 0.2% in 1991 and then fell steadily through 1995. A decline of 8% over 4 years that was a clear indication that the supply of goods exceeded demand at the wholesale level. Credit growth slowed sharply, reflecting a lack of viable investment opportunities in Japan's glutted markets in spite of rapidly declining interest rates. Finally, the stock market and property prices began to collapse in a slump that has subsequently reduced stock prices by 75%, and property values by more than 50%. This pattern of extraordinary foreign capital inflows leading to an acceleration of lending, overinvestment, overcapacity, and asset bubbles followed by falling prices and economic collapse was repeated all across Asia from the mid-1980s to the mid-1990s. It had been called an economic miracle, but, in its later stages, it was only a credit bubble. Developments in Thailand clearly demonstrate this sequence of events. The Asian Miracle Bubble. The most miraculous thing about the Asian miracle was how big the economic bubble in Asia became before it popped. It should have surprised no one that small economies grow very rapidly when inundated by enormous amounts of foreign capital. Almost everyone, however, including government policymakers, the IMF, bankers, and stockbrokers, failed to understand that the foreign capital inflows were creating an unsustainable economic boom. Even now, the unwillingness of those players to admit they were misguided has prevented the obvious explanation for the crisis from becoming commonly understood and accepted. Consequently, the most prevalent theory is still that the Asia crisis was caused by the sudden outflow of foreign capital in 1997, when, in fact, it was not the outflow of capital, but the huge inflow of foreign funds during the preceding 10 years that had created the bubble in the first place. The outflow of funds was only part and parcel of the panic that occurred as the Asian credit bubble imploded. The pattern of events was quite similar in all the crisis-affected countries: Thailand, South Korea, Malaysia, and Indonesia. Here, Thailand will be used as the case study to illustrate how the Asian miracle inflated and then popped. As in the case of Japan, Thailand's economic bubble was characterized by rapid economic growth and rapid asset price inflation. The boom began in the mid-1980s when Japan, in response to a sharply appreciating yen, began to relocate its manufacturing capacity to the rest of Asia. Direct foreign investment from Japan put an end to the 1984 recession. By 1986, the boom had begun. Money supply accelerated and GDP expanded at double-digit rates. By 1990, property prices across the country had risen between 400% and 1,000%, and the surge in the stock market had exceeded all past records. See Figure 2.10. Figure 2.10 The Stock Exchange of Thailand Index, 1988 to 2001, year-end. Unlike what had occurred in Japan, however, Thailand's bubble economy came about not due to a trade or current account surplus, but rather despite an impressive string of current account deficits. See Figure 2.11. Figure 2.11 Thailand, current account balance, 1980 to 96. Nevertheless, just as in Japan, the bubble in Thailand was caused by extraordinary amounts of foreign capital entering the banking system and resulting in excessive credit creation. In Thailand's case, this did not result from trade surpluses, but rather from surpluses on the financial account. See Figure 2.12. Figure 2.12 Thailand, Financial Account Balance, 1980 to 96. Foreign capital entered the kingdom in various ways, as direct foreign investment, as portfolio investment in the stock market, as bank loans, and as deposits which were placed in Thai financial institutions to take advantage of the high interest rates on offer. These capital inflows were so large that they more than offset the country's large current account deficit and resulted in an extraordinary buildup in foreign exchange reserves. The annual increase in international reserves is reflected in Figure 2.13 as the surplus on the overall balance. Figure 2.13 Thailand, breakdown of the balance of payments, 1980 to 96. Thailand's international reserves rose from $1.9 billion in 1984 to $37.7 billion in 1996, an increase of 1,884% over a 12-year period. It is little wonder that a credit bubble developed, see Figure 2.14. Figure 2.14 Thailand, total reserves minus gold, 1984 to 96. Regardless of the original reason that the money entered the country, eventually that money entered the banking system and, as it was deposited into Thai banks, money supply exploded, see Figure 2.15. Figure 2.15 Thailand, growth in money plus quasi-money, 1984 to 96. This rapid expansion of Thailand's money supply was not due to the Bank of Thailand printing money. As Figure 2.16 demonstrates, most of the increase was in quasi-money, defined as time, savings, and foreign currency deposits. Deposits multiplied as unprecedented amounts of foreign funds entered the country. Figure 2.16 Thailand, money supply, 1983 to 96. Before demonstrating how this flood of capital inflows transformed Thailand's economy, it should be noted that the largest part of the capital entering Thailand came from Japan, which attempted, but ultimately failed, to prevent its enormous current account surpluses from causing domestic overheating by exporting huge sums of capital abroad. It must be recognized that Japan's giant current account surpluses, after 1982, not only created the bubble economy in Japan, but were also responsible for the bubble economies which later developed all across Asia. As Table 2.2 and Figure 2.17 illustrate, Thailand's boom began in earnest in 1987 after the country's international reserves began to surge in 1986. Table 2.2 Thailand, the relationship between reserves, credit, and GDP, 1984 to 95. Figure 2.17 Thailand, the relationship between reserves, credit, and GDP, 1984. In 1988, when domestic credit expanded by 29%, Thailand's GDP increased by 13.3%. Over the next 7 years, up through the end of 1995, this astonishing economic expansion continued. The annual growth in central bank reserves averaged 29.5%, domestic credit growth averaged 28.7% annually, and the GDP increased by approximately 9% on average, and all this despite serious social and political unrest in 1991 and 1992. Beyond all question, this was a credit bubble of terrifying proportions. Initially, direct foreign investment and portfolio investment in equities combined were a more important source of foreign capital than bank loans. By 1993, however, debt began to swamp equity as the primary source of foreign capital entering the kingdom. See Table 2.3. Thai corporations found they could raise large sums on the international bond market, and foreign banks became increasingly eager to lend in Thailand. By then, much of the incoming capital was in the form of non-resident deposits, that is, short-term, hot money, deposited in Thai financial institutions in order to benefit from the high interest rates on offer there. Equity investment also became increasingly short-term and speculative in nature. For instance, a sudden surge in hedge fund-driven foreign investment in listed equities drove the stock market index up 75% in the last quarter of 1993 alone. Table 2.3 Thailand, sources of foreign capital, 1984 to 95. A tightening of interest rate policy in the United States in early 1994 caused a sharp correction on the stock market that year, but did nothing to slow foreign bank lending, which more than doubled from $6.6 billion in 1993 to $14.3 billion in 1994, an amount equivalent to more than 8% of the size of the entire Thai economy. A credit-driven investment boom of this magnitude was clearly unsustainable. Domestic industries of all descriptions dramatically increased their capacity as quickly as they could obtain new funds. Overcapacity became pervasive. Oversupply was most obvious in Bangkok's glutted property market, where an extraordinary building boom brought about an increase in supply of office space on the order of 400% between 1986 and 1995, giving rise to the joke that the crane was Thailand's national bird. Naturally, rents plummeted as vacancy rates soared. Likewise, in other industries, as overcapacity became the norm, product prices plunged. Corporate profit growth slowed and then turned negative. Thailand's bubble economy hovered uncertainly through the long, unprofitable months of 1996. By the end of that year, the stock market index had fallen below the 1,000 level for the first time since 1993, and it was clear that much worse was in store. Finally, with a prick heard around the world, Thailand's bubble economy met its inevitable fate on July 2, 1997, when currency traders forced the devaluation of the Thai baht, ending its quasi-peg to the US dollar that had existed for more than a decade. Subsequently, the baht lost more than 50% of its value against the dollar, and the Thai stock market fell by approximately 95%, in dollar terms, from its all-time high reached in late 1993. Just as in the case of Japan, excessive inflows of foreign capital caused an expansion of reserve assets and commercial bank deposits that permitted an acceleration in lending. In both instances, bubble economies formed and then popped when overcapacity caused prices and profits to contract. Even today, industrial capacity utilization is less than 55%, and the vacancy rate in the property market in Bangkok exceeds 30%. The extraordinary buildup in international reserves of the other crisis-affected countries from the mid-1980s is sufficient to demonstrate that the same pattern of capital inflows leading to excessive monetary expansion and economic overheating occurred across the region and was responsible for one of the greatest economic boom and bust cycles of the 20th century. See Figure 2.18. Figure 2.18 Bubble Fuel, Total Reserves minus Gold, 1970-96. Chapter 3. The New Paradigm Bubble. The functioning of the international monetary system was thus reduced to a childish game in which, after each round, the winners return their marbles to the losers. Jacques Rueff, 1961. In 1961, the brilliant French economist, Jacques Rueff, published a prophetic article in Fortune in which he warned that U.S. balance of payments deficits threatened to bring down the international monetary system. 10 years later, President Nixon suspended the convertibility of U.S. dollars into gold. The Bretton Woods system had been destroyed by the U.S. balance of payments deficits, just as Rueff had predicted. Rueff used the analogy of a game of marbles to demonstrate the problems caused by the deficits. He wrote that the international monetary system was being reduced to a game of marbles, in which, after each round, the winners return their marbles to the losers. Or, more specifically, the process works this way. When the US has an unfavorable balance with another country, let us take as an example France, it settles up in dollars. The Frenchmen who receive these dollars sell them to the central bank, the Banque de France, taking their own national money, francs, in exchange. The Banque de France, in effect, creates these francs against the dollars. But then it turns around and invests the dollars back in the US. Thus the very same dollars expand the credit system of France, while still underpinning the credit system in the US. Chapter 2 demonstrated how the economies of Japan and the Asia crisis countries underwent dramatic boom and bust cycles as their balance of payment surpluses caused rapid expansion within their credit systems. This chapter will show how those same surpluses have boomeranged back to the United States and caused economic overheating and asset price bubbles in that country as the winners return their marbles to the losers. The boomerang currency. Who said you can't have your cake and eat it too? The United States does. Each hour now, the US buys $50 million more in goods and services from the rest of the world than it sells to the rest of the world. The US current account deficit was $130 billion during the second quarter of 2002. It appears very likely to exceed $500 billion for the full year. Moreover, given current exchange rates, there is every reason to believe that it will continue expanding from these levels. What does the United States exchange for this deficit? Essentially, paper dollars, and other US dollar-denominated assets. It certainly could not pay with gold. Its gold reserves would have been depleted long ago had the US settled its trade deficits with gold. What's even more remarkable, because the United States is the issuer of the world's preferred reserve currency, those dollars must buy US dollar-denominated assets if they are to earn a positive rate of return. If the central banks around the world that have built up hordes of paper dollars as a result of their country's trade or financial account surpluses just stick that currency in a bank vault, it won't earn anything. On the other hand, when those central bankers buy US Treasury bonds, Fannie Mae's, US corporate bonds, or even stocks, they earn interest income on their dollars. The only alternative to locking the dollars away in a vault or to buying US dollar-denominated assets would be to exchange those dollars for their own currency. That would have the effect of driving up the value of their domestic currency, which, in turn, would make their country's exports less competitive and put an end to their country's balance of payments surplus, an unattractive alternative that is almost always avoided. Once again, the US buys a lot more from the rest of the world than it sells abroad. It pays with paper dollars. Then it gets those dollars back as its trading partners invest their dollars in US dollar-denominated assets, in order to earn a return on that paper. There's more. The amounts involved keep getting bigger every year. The larger the US current account deficit becomes, the larger the amount of US dollars that wash back into the United States through its financial account surplus. Figure 3.1 shows how it looks as a breakdown of the balance of payments. Figure 3.1 United States, breakdown of the balance of payments, 1984 to 2000. As those dollars return to the United States, they have helped drive up stock prices and property prices and helped push down interest rates. However advantageous this arrangement has been thus far, there are a number of very serious problems associated with it. First of all, those countries that accumulate large surpluses develop bubble economies that inevitably pop, leaving their banking sector in tatters and their government deeply in debt. Second, as the surplus countries have used their dollars to acquire US dollar-denominated assets, it has resulted in capital misallocation, severe asset price bubbles, and economic overheating in the United States that must also end in bankruptcies, deflation, and financial sector distress. Finally, it is completely unsustainable. The United States cannot continue to go into debt to the tune of 4 to 5% of its GDP each year, as it did in 2000 and 2001, indefinitely. At some point, the rest of the world will no longer be willing to accept 50 million paper dollars an hour in exchange for their products. Then, with the US no longer able to act as the world's engine of growth, a terrible economic readjustment process will ensue. At the time of writing, with corporate bankruptcies in the United States setting new records, with share prices swooning, and the dollar under pressure, it appears that this readjustment will occur sooner rather than later. In fact, in light of the horrific failures at Enron and WorldCom, it may not be an exaggeration to say that the US economy has begun to choke on its own debt. Already, most of the countries that have built up large foreign exchange reserves through trade or financial account surpluses have experienced extraordinary boom and bust cycles and are now left with the deflationary consequences. That process was described in the last 2 chapters. Also, dangerous asset bubbles have built up in the United States. Nasdaq in early 2000 was just as absurdly overvalued as the Thai stock market was in the mid-1990s. The new paradigm asset misallocation verged on the insane, the criminally insane. Such bubbles can only inflate so far before their inherent folly becomes manifest and they are cut off from additional credit. Then, boom turns to bust. The recession that began in the United States in 2011 was as inevitable as night following day. The recovery in early 2002 was nothing more than a dead cat bounce. Chapter 2 showed how current account and financial account surpluses caused the bubble economies in Japan and the other crisis-affected countries in Asia. This chapter will demonstrate how the U.S. financial account surpluses, which are actually only a function of the U.S. current account deficits, see Figure 3.2, have caused economic overheating and severe asset price inflation in the United States through a process of credit creation. The cumulative U.S. financial account surplus has exceeded $3 trillion since 1983. That is a very large sum. That inflow has made it easier for the U.S. government to finance its debt and for U.S. corporations and government agencies, such as Fannie Mae and Freddie Mac, to sell their bonds. The flow of funds statement published by the Federal Reserve provides details on how those capital inflows have been invested in the United States. The data from 1995 to 2000 are sufficient to demonstrate how the U.S. economy has been affected. Table 3.1 shows the rest of the world's net acquisitions and increase in liabilities in the United States. The difference between the two represents the rest of the world's net financial investment in the United States. This figure is closely related to the U.S. financial account surplus. Figure 3.2 United States, current account versus financial account, 1969 to 98. Table 3.1 The rest of the world's net foreign investments in the United States, 1995 to 2000, US dollars billion. The breakdown of the net acquisition of financial assets, see Table 3.2, reveals a sharp rise in U.S. corporate equities and direct foreign investment into the United States, and a relatively stable level of investment in credit market instruments. Table 3.2 The rest of the world's breakdown of net acquisitions of financial assets, 1995 to 2000, US dollars billion. The breakdown of credit market instruments, see Table 3.3, reveals a steady decline in U.S. government securities and a steady rise in investments in U.S. corporate bonds. Table 3.3 Breakdown of credit market instruments acquired by foreign investors, 1995 to 2000, US dollars billion. Finally, the breakdown of U.S. government securities, see Table 3.4, shows that foreign investors have not only reduced their holding of U.S. Treasury bonds, but have even become net sellers, a trend that resulted from the government budget achieving a surplus in 1997 and the subsequent retirement of a portion of the Treasury bonds outstanding. At the same time, foreign investors sharply expanded their holding of government agency bonds, such as Fannie Mae's and Freddie Mac's. Table 3.4 U.S. government securities acquired by foreign investors by type, 1995 to 2000, US dollars billion. What all of the above tells us is that the rest of the world took its current account surplus and bought increasing amounts of U.S. stocks, corporate bonds, and agency debt, adding up to 444 billion US dollars, 693 billion US dollars, and 422 billion US dollars, respectively, between 1995 and 2000. Those investments in stocks helped create the NASDAQ bubble. The investments in corporate bonds facilitated the misallocation of capital that is now laying low the dot-coms and the telecommunication companies, among others. And the investments in agency debt have helped fuel the boom in U.S. property prices that has allowed the U.S. consumer to extract additional equity through refinancing his home in order to keep spending more than he earns. The impacts that these investments have had on the U.S. economy have been considerable in and of themselves. However, these inflows have also impacted the economy in a second and even more powerful way. They have entered the U.S. banking system as deposits and have acted as high-powered money, setting off the surge of credit creation that was the root cause of the great end of the millennium boom in the United States. See Figure 3.3. Figure 3.3 United States. What is the relationship between money supply growth and the surplus on the financial account, 1984 to 2001? This is not to suggest that those funds went directly on deposit when entering the United States. Nonetheless, regardless of what type of asset was initially purchased with those funds, eventually, most of that capital worked its way into American banks. For example, if the capital inflows were used to buy government bonds, the government spent the proceeds on goods and services, and the providers of those services deposited the payments they received from the government into their bank accounts. The same is true regardless of whether the funds coming into the country were used to buy corporate bonds, stocks, or any other kind of asset. Unless the money was hidden under a mattress or destroyed, most of it would have entered the banking system as deposits, and deposits make up most of the money supply. When funds from abroad enter a banking system as deposits, they are not relent only once. The original amount that is lent will be redeposited and then relent and redeposited numerous times. This process of credit creation is only limited by the bank's need to maintain sufficient capital adequacy and prudential reserves to satisfy bank regulators. In this sense, the foreign inflows act as high-powered money, just as if they had been created by the open market operations of the central bank. Therefore, the $3 trillion in capital inflows after 1983 did much more than finance an additional $3 trillion worth of debt. Those inflows were deposited, lent out, redeposited and relent multiple times. In that way, they caused the U.S. money supply to expand, fueling the bubble economy that emerged in the United States in the second half of the 1990s. See Figure 3.4. Figure 3.4 United States, money supply growth versus the financial account surplus, 1984 to 2001. In 1980, total credit market assets in the United States amounted to $4.7 trillion. By the third quarter of 2001, that figure had risen by more than 500% to $28.9 trillion. See Figure 3.5. Figure 3.5 United States, total credit market assets, 1980 to 2001, Q3. Over this period, credit market assets, that is, debt, grew at a much faster rate than the U.S. economy. Debt increased by 510%, while the GDP grew by only 246%. This difference is all the more striking when it is recognized that the GDP growth itself was in large part fueled by the expansion of debt. See Figure 3.6. Figure 3.6 United States, total credit market debt versus GDP, 1980 to 2001, Q3. Credit could not have expanded this rapidly in absolute terms or relative to GDP had the foreign capital inflows not driven up the money supply as it entered the banking system. Taking one step back, the foreign capital inflows would not have existed had they not been created by the U.S. current account deficit. Finally, recall that such large current account deficits would have been impossible under the classical gold standard, or even the Bretton Woods system, because they would have drained the United States of its gold reserves, causing a contraction of the monetary base and throwing the country into a severe economic slump. Once the restraints imposed by the rules of the gold standard were thrown off once and for all in 1973, paper replaced gold as the foundation of the world's monetary system. However, because one country, the United States, found itself in the fortunate position to call into existence unlimited amounts of paper dollars, or dollar-denominated debt instruments, and exchange them for the goods and services of other countries, a new international reserve currency, dollars, began flooding into the banking systems of all its major trading partners. That ignited an explosion of credit, not only in the countries with trade surpluses with the United States, but also in the United States itself, as the dollars earned by its trading partners were reinvested in U.S. dollar-denominated assets in the United States and, ultimately, deposited into the U.S. banking systems. While many diagrams have been employed thus far to demonstrate the development of the global credit bubble that has brought about the present extreme disequilibrium in the world economy, none sums it up more strikingly than Figure 3.7, which shows the increase in U.S. currency held by the public. Figure 3.7 Currency held by the public, 1890 to 2000. Because dollars have replaced gold as the new international reserve asset, Figure 3.7 helps to illustrate the near exponential explosion of the global money supply since the Bretton Woods system broke down. Those crisp green pieces of paper have acted as high-powered money as they entered the world's banking systems, just as gold would have. They have unleashed an unparalleled increase in credit around the world. That credit has blown the global economy into a bubble. Bubbles Pop Part 2 examines the reasons bubbles pop. First, however, Chapter 4 will demonstrate that the first global bubble of the 20th century came about for the same reasons as the final one.